there's this iconic moment where Ronald Reagan goes to the stock market and proclaims that let that bull loose. I'm not saying that this is the same kind of thing, but I do think that Trump's cabinet will probably be over proportionally represented by Wall Street people. It does seem like we're setting up for uh, continued bull market.
I'm very pleased to welcome to Monetary Matters a very special investor and analyst. He goes by the name Citrini. He has seen around corners a lot and had some very good results in the markets, being very early on artificial intelligence, being very early on Ozempic, commonly known as GLP-1s. And he has been on my previous program, Forward Guidance, many times and had some very, very good calls. So we'll see if the calls he makes on this show age as well as the ones he has made previously. It's going to be hard, but we'll see what we can do.
No
The
pressure, right?
Yeah, James, the most recent call you made on Four Guys, my old show, was in June. You came on and said you'd constructed a Trump basket, and it had all the stocks that you thought would do well if Trump would win. Tell us about, obviously Trump has won, and there's a Republican sweep. What was in that basket? What and why? Why did you think those would do well? And are you still bullish on that basket now that Trump is in office?
Thanks for having me on again, Jack. Like I said, no pressure, right? A series of good calls. It doesn't mean that these ones are going to be good, but we created a basket back in March of 2024 that was a long short basket. We presented it two ways. The first way was net long, which we recommended because we felt that the view that Trump would be perceived as positive for markets necessitated that you have a net long implementation in any long short kind of Trump play. But the other one that we presented was market neutral, which we felt would more accurately track odds, right? So we spoke about that a little bit last time. I think we touched on a couple of our kind of Trump sub themes, which I think the one we spent the most time on was EU defense, on the concept that Trump had comments about you have to 2% of your GDP if you want to be in NATO, or else Russia can do whatever they want to you. And we had a couple other ones, and honestly, pretty much all of them have kind of played out. I mean, the best case scenario for this basket was a red sweep, which is uh, looking like what we got. And now the question becomes, do politicians sometimes say they're going to do things and then end up not doing them? Which I think the answer is yes. And then I guess a corollary to that question would be, is Trump predictable? So the answer to that is obviously no. So, I think that there have been a couple very significant overreactions in markets, probably more so on the macro side. Although, some equities have also gotten a little bit speculative. Something that we spoke about last time was the Fannie Mae Freddie Mac privatization, and that was the first thing we had written about in relation to Trump, right? Because back in December of last year, his odds of even being the candidate were not 100%, and it was something that we thought would trade as a kind of swap on Trump odds, and it seemed relatively asymmetric. And we still have no view on whether that actually happens. But it was something where the market incrementally pricing more of a chance of it actually happening became an insanely asymmetric bet, especially on the preferred. So there's a lot of other stuff like that too, where, for example, Geo Group and private prisons. Geo Group. I haven't looked, but I'm pretty sure it's up probably 50 or 60% this week. And
It was
Geo
last
Group,
night. Yeah, it's
yeah, Geo Group is a good business, right? And that's great, and it probably was undervalued just regardless of who won.
68%.
Yeah, and at the same time, is that priced in now? And I think that going through this basket, there are some areas that seem safe to keep on through the inauguration and through at least the next 2 years, barring any crazy upsets. And then there are some areas where it's a little bit frothy, and you probably want to reevaluate this part of the trade is probably over, and let's look if we want to continue playing the net impact of Trump on a portfolio. We should look at things that are more certainty rather than speculation.
Right. And James, based on your own reporting, I haven't verified this, but the Trump net long basket from its inception in March 4th, it was up 76%. Since we did our interview on June 18th, that's when it aired, the Trump net long basket's up 49%. Since its inception March 4th, the market neutral is up 31%. And since June 18th, it is up 25.5%. I also want to say that you did a clearly, unsurprisingly, a very good job constructing a Trump basket that would do well if Trump won. So you did a good job of constructing that basket, but it just so happened that Trump won, and that you created this index not necessarily as a way to make money, but to hedge against, I believe, your fiscal beneficiaries. Basically, the Inflation Reduction Act passed by the Democrats and Biden. You wanted to get a hedge of that, as well as a way to track Trump's odds of is he going to win the election. I think there are a lot of flowers being shown, rightfully so, to Polymarket and Kalshi, all these betting websites that showed people were betting that Trump was going to win, and the market is correct, a version of the efficient market hypothesis. We can put on screen this chart right here, showing just your chart in blue of how well that has done, and basically how that led the betting odds. So your long short basket of the Trump basket led all the betting markets, which is very interesting to me, and I'm happy I know you, James.
Well, it was really, this is something that goes beyond the election, where I think that on average the quality of kind of thematic baskets out there from the sell, especially sell side baskets, they're colored by what's in the bank's coverage, and when you look at the value of me to constructing these baskets, even if they're not actively allocated to, is the signal value, right? You could say, oh well, you could just look at how DJT is trading to get a read on Trump, or you could look at how Nvidia is trading to get a read on GLPs. But when you have a big enough theme, they broaden out, right, and they start affecting myriad different things in the market. And this specific instance was really valuable when you look at the debate that was happening surrounding Polymarket, and you had what we now know to be a French trader that created a pretty significant bet on Trump that, because of the relative illiquidity of the Polymarket, skewed the odds. And you had a huge debate about are betting markets broken? Is this market manipulation? And I guess now we see, first off, it wasn't, right. If expressing a view in size is market manipulation, then I think a lot of us are in a lot of trouble. But the other thing was, you could look at this basket, which was rallying coincidentally with those wagers, and you get a signal there where maybe you're undecided on whether or not this crypto market is being kind of manipulated, or if it's broken, or if the liquidity is making something seem more significant than it really is. And that was entirely possible, right? It's crypto markets are no stranger to manipulation, but it would be something entirely different if those bets were somehow influencing the entire stock market, right? There are 105 securities in this basket, so we looked at that, and then we cross-referenced it with this, and they tracked very closely, and that made it a pretty simple thing to say, well, it's probably just someone really believes that Trump's going to win, and the fact is a lot of other people in the market believe that Trump is going to win. And when it comes to an election, it's mainly just people expressing their it's a shame that I wasn't doing this in 2016, because it would have been nice to look at the performance of whatever Trump versus Clinton basket would have been, and you can't really go back and do that without a significant amount of bias at this point.
And it's extremely hard to know not just what certain administrations are going to do, how that will impact the fundamentals, but how these security prices will trade. For example, everyone thinks Trump's so friendly to oil, Biden super unfriendly to oil, but oil stocks did extremely well during the Biden administration, and
Yeah.
permitting went up as well. And also, for example, Biden is great for clean energy. You point out how that there are a lot of clean energy stocks that actually were kind of bubbles slash frauds, and they peaked when Biden got inaugurated. And it just so happened that a lot of green tech, therefore, as a basket, has performed quite poorly under the so-called green president. So it's hard to predict. James, let's get into a few of these sub themes of your Trump basket. There's long European defense stocks and short U.S. defense stocks. There's long beneficiaries of tariffs, short people who are hurt by tariffs. There is some idiosyncratic stuff. There's the private stuff. I really want to talk about capital markets. So Jefferies, Carlyle, Piper Sandler's, Evercore. So all banks, not just the capital markets, but all banks are going on fire. Do you think that's kind of justified? And also, you're no stranger to investing in banks. And do you think that is this sending a signal that the economy is actually going to be fine? Because if there was no election that is causing this huge rally in bank stocks, I would be forced to interpret it as the market is screaming, "Are you kidding me? There's no chance that there's going to be a recession." And actually, we're trading as if we're emerging from a slowdown and things are about to reaccelerate. So,
Yeah.
what do you make of bank shares and how they've been impacted by Trump's presidency?
Well, the fact that it's a red sweep, actually more kind of nuanced is the fact that when you have a first-time president, right? Even if it's a sweep for their party, there is a period of they get into office and they have to acclimate and see what parts of their plan meet resistance in the party and see what they can easily pass, and they kind of have to. It's just like starting any other job. You have to learn how things work, and then when you're a president and you get reelected, you've been there for 4 years, and maybe you have a lot of initiatives that are already in the works, and there are things that you want to focus on that are kind of obligations rather than kind of goals. And so it's a pretty interesting dynamic where Trump has already been president, and at the same time he's not being reelected for a consecutive second term. So it's really a situation where he can hit the ground running. And for something like that, I think you do want to position yourself in the more obvious impacts of that, right? So for me, one of those for sure is increased M&A activity, and I think that the moves that we've had in boutique M&A names like Evercore or Piper Sandler or Jefferies, those are 100% accurate, right? That doesn't strike me as a overreaction or froth. Those are things where sometimes something hits you in the face and it's obvious, and you say, "Yep, that's probably what's gonna happen," and that's how I want to be positioned. And at the same time, you have a wide index. I mean, we just what we've been working on recently is creating a. We're now looking at baskets that we would feel more comfortable keeping on from this point, rather than having put on back in March. And the two areas that we're looking at are tax policy and then the regulatory overhang. So when Trump gets in, there everyone is kind of aware of this, but it's been an interesting process to go through. And the first thing we did was we said, what is every single company that Lina Khan has ever spoken negatively about? And we probably want to be long all of those. And then let's go sector, what about the EPA? And what about the FCC? And, what about who is the Department of Justice currently investigating? And going kind of case by case in a more qualitative than quantitative manner to say, which of these companies are pretty obviously going to benefit. For example, like Coinbase, right? If Trump gets in, Gary Gensler gets out, well, Coinbase is probably going to do pretty well. And the other ones that you might look at are companies that have you know active M&A or even have spoken about doing M&A, but have held off because of the regulatory environment and the concerns that, Lina Khan would come in and say, nope, you're not doing that. So we've created that basket, and there are a lot of companies that, if you can basically buy these companies that have a history of being very good capital allocators and a history of kind of making these accretive acquisitions that have seen sustained kind of reduction in the M&A activity, it seems to me relatively clear that uh, besides obviously rates, part of the reason for that is a concern with the government's reaction. And that seems like somewhat of a certainty from here. And the other kind of certainty, now that it's a red sweep, the tax bill emanates from the House. So the idea of like tax cuts and the TCJA in a red sweep, the TCJA extension is that's the Tax Cuts and Jobs Act. It was Trump passed that in 2017, and what we did was kind of looked at the companies that had a significant benefit in their after-tax earnings because of the TCJA's tax cuts, because I think that pretty well accurately represents Trump's priorities. And when Trump got in the first time for the first 2 years, he had a Republican Senate and House, and that is so. I think we can kind of over-index to that period and say, this is probably going to look like what it looked like from 2016 to 2018. And in any comparison, you kind of want to drop COVID out of sample. COVID was you don't want to look at what we did with the CARES Act or even fiscal spending in relation to COVID. And I think that is coloring a lot of people's perception of what the deficit will look like. And don't get me wrong, either candidate was going to increase the deficit, but some of the projections seem to maybe think that Trump will be a little bit more Dear than he really is going to be. I don't think that he's going to be increasing the deficit by $15 trillion. It seems that this time he probably has a more considered and calm plan for who the cabinet's going to be. Just looking at the likely Treasury Secretary pick.
Mhm.
Scott Bessent, very just super smart guy.
He worked for
Is going to
Soros.
be, yeah, and just that alone kind of gives me a bit more confidence about. I don't think we're going into, the move on the long bond was clearly a bit of an overreaction. So the last time that we spoke about this in June, I was pretty adamant that I didn't want to make a slew of kind of macro recommendations, and whether that was a good idea or not. The interesting thing is that if you look at the move in most macro instruments in response to Trump's 2016 election, I'm not a big fan of analogs, but that analog is very impressive, right? They basically tracked 1-to-1. But the only thing that I was really confident on was the steepener, right? That would be the kind of easiest way to win in macro off of a Trump victory. It turned out that you probably could have made a lot more money just being short long bonds. But what we've seen with the steepener, you can attribute it to Trump, you can attribute it to the economy or whatever you want to attribute it to. But at this point, looking at it, I mean, the move in the long bond seems a little bit overdone to me, because it's reflecting a fiscal outlook that I think might be skewed or too colored by the government's response to COVID, and also probably takes too rosy of an outlook on which of Trump's promises he will actually keep. Because
Or James, I could say the 10-year going up, 30-year going up is pricing in higher inflation because of tariffs.
yeah, and let's talk about that, because I feel strongly that and I said, I published something on this the night of the election that obviously the knee-jerk reaction to Chinese equities was sell them because of Trump. If you look at the trade war that we had the last time that Trump was president, it was actually a net positive for Chinese equities, it seems. Or at least they didn't care that much in the long, they there was no big sustained sell-off from 2016 to 2018 in Chinese equities because of Trump's China stance. And it's not like we're going from really adamant China dove who is just totally globalist and supportive of globalization and yeah, China, let's do all the trade with China. No, Biden is also a kind of protectionist, and when it comes to China, it's not like we have tariffs on plenty of companies, Becton Dickinson, for example. And so I think that the pricing of the inflationary impacts of tariffs, I think it's overdone. I think that your best bet on election night, which is what we did, was to buy the dip in Chinese equities. Not only because I don't think that we're actually going to get a blanket 60% tariff. Everything has been so black and white in the coverage of the election, right? It's either this one gets elected and we don't have to worry about tariffs at all, or this one gets elected and it's 60 or 100% tariffs on everything, and that's not how things work. I highly doubt that we're going to see a blanket 60% tariff. And even if that's the threat that's on the table, that's exactly what it is. It's a threat because if you think about Trump's kind of motivation, his platonic ideal, so to speak, is the deal maker. And
Part of the deal.
yeah, so yeah, exactly, the art of the deal. So do we think that he's going to come in and immediately say, yeah, 60% tariff, go? Yeah, but no, obviously there are people around him that are saying, hey, this might not be great. But he has that kind of perception on the global stage where just crazy enough to do it. So that puts him in a negotiating position for a trade deal with China that I don't think we'll ever actually need to see a 60% tariff. Especially, it looks like Elon Musk is going to be part of the cabinet. Do you think that like he is going to really? Yeah, you should put 60% tariffs on every Chinese renewable, this, that, or the other thing.
No.
Probably not. So I think that that's a little bit overdone. I do think, and kind of closing the circle on the idea of being long Chinese equities. The response at the government level to the threat of US trade policy that can exacerbate their dire economic straits is almost certainly going to be to increase the size of their planned fiscal response. And that's exactly what the market is looking for. So, we had Chinese equities trading off, 2 or 3% on Trump getting elected, and that's a buy because it's a situation where not only is the tariff risk probably overpriced, but the market is going to get what it's been waiting for a long time. I wouldn't be surprised if even, this weekend we get an announcement of a fiscal package that's, maybe like 3 trillion renminbi. Just they're going to increase the size of it because they feel the need to get out in front of it. And I think that it's something where we've been waiting for China to have the motivation to actually do this kind of stuff, and you're seeing more and more signals that it's time. And I think that by the end of the year, a few people are going to owe David Tepper an apology for accusing him of just trying to pump his own positions.
So you thought that Trump election would cause a steeper in the yield curve, basically long-term interest rates to go up more than short-term interest rates. That is what has happened. But you actually think that long-term rates, 10-year, 30-year bond yields on the Treasury might be a little bit too high because they're pricing in a little bit too much inflation from tariffs, a little too much fiscal recklessness, and you think it actually will be slightly more measured. That's interesting. Let's talk about China. You have had a barbell position in China. Full disclosure, I also happen to be trafficking, quite heavily in Chinese securities, and so you and I were quite pleased with the massive move in late September, early October, when there was the Chinese stimulus, and David Tepper issued that saying on CNBC. Since then, it's kind of stalled out a little bit. What are you making of it, and how are you comparing maybe this types of securities that you own versus the CSI or the Shanghai, the Chinese indices?
Our approach to China has been what we've been calling it is don't fight the Fed with Chinese characteristics. Because China's a very top-down economy that's driven by the whims of a single guy. And so we've been waiting for the signal that the instructions from the top are to improve the economy without condition. And one of the bigger signals that we were waiting for was you had this dynamic where all these local government officials that had kind of lined their own pockets through the previous stimulus that kind of got them here in the first place were, you might be a local government official that retired and you're in Macau and gambling away your savings, and then all of a
That's the dream.
sudden,
What a life that
yeah,
sounds like.
absolutely, and then all of a sudden, the Chinese police show up and they say, come with us. You're going to prison because you were irresponsible with the people's money, and that kind of thing was happening, and it would happen 2 days after they said, hey, we're gonna take the local government. We're really gonna help the local governments improve the economy. It's okay. Well, you can't have your cake and eat it too, right? You can either uh, encourage the stimulus of the local governments, or you can be throwing the guys in jail because you're not going to oh look, you can borrow money, and here's this plan, and nobody's going to actually go out and borrow money if they think that there's a risk that if they do it improperly they're going to prison. So what we saw at the party congress was the announcement of it's called the three exempts. So they're basically saying, if we think that you're actually eagerly and earnestly trying to stimulate your economy, we're not gonna throw you in prison if there's some stuff that goes on. So that was a big signal. And basically, in terms of equity selection in China, we've really taken the tack that you don't want to just own China broadly, because the risk of drawdown just on overreactions, especially in ADRs and H shares, is just too large. You want to position yourself to be aligned with the areas that the CCP wants to encourage growth in. So that's semiconductors, right? The China also wants to do AI. That's it's like dairy, for example, that they've been trying to get people to drink milk for a very long time, and that had some disastrous consequences. But now they're kind of bolstering that industry. There are a collection of stocks that we own that are probably skewed more towards demand side stimulus rather than supply side. But we have exposure to both, and you can see here on this chart what we call the Chinese equity barbell, which originally was the one side of the barbell is demand side stimulus beneficiaries, basically trying to stimulate demand, and then the other one was supply side stimulus, which is what we've seen historically, at least in China. And then the kind of the actual bar of the barbell, we funded these positions with a 3 times the notional short. We basically FX hedged it 3 times over. But you can see here the drawdown since that kind of blow off top. It's we've had a lot of cushion, and that's been from primarily like the AI semiconductor, the idea that regardless of what happens with stimulus, if China wants to do AI, they're not going to be able to do it effectively, at least with NVIDIA chips. They'll be able to get some, but not the kind that you need to do what China wants to do in AI. So that's kind of been our approach. But as far as the election is concerned, even broadly in China, I do think that there is upside from this, and that selling it on the result of the election is probably going to be a mistake, and something that people that have done it will regret.
So you're bull on China. What else,
Mhm.
James?
Well, as far as the kind of sub themes that we had in our overall allocation for Trump, like I said, tax policy, the TCJA extension, that is an area that we're focused on. The regulatory overhang being lifted from deregulation is another. And then we have some more specific sub themes, some of which I think probably are already priced like everything's there already, and then some that aren't. Like we said before, the NATO and defense names in Europe, Rheinmetall, Thales, Safran, and then the tariff winners losers. I don't think that it really continues very significantly, but what I do think continues, I think that the the positive exposure to law enforcement, something like Axon Group and CoreCivic, Geo Group, even Aramark, these kinds of names probably will continue to benefit. Maybe they've gotten a little bit too frothy, but I would probably be a buyer on any pullbacks. And then one of the other sub themes that we focused on was onshoring versus nearshoring, which is the concept that the Biden administration has focused on. Again, coming back to the fact that neither of these presidents are China doves, right? But the Biden administration's tack for kind of securing the supply chain was very much more focused on friendshoring or nearshoring, or basically moving production to allied countries like Mexico. Um, we don't see that continuing as robustly as it has under a Trump presidency or a red sweep scenario, because Trump's just not a fan of Mexico. And I think that but onshoring is a tricky thing to position yourself for, because ideally you would say, well, yeah, we're going to move manufacturing to the US. But there are areas that will pretty much cease to function in it's not like any illegal immigrants are going to immediately be gone the day he's inaugurated. But if you think about just like the cost of labor and the way that certain industries function, especially in agriculture, you know, the migrant labor is a huge part of agriculture, especially in California. And if you don't want to be paying $10 a blueberry, but you want to onshore and also get rid of illegal immigration, there's some stuff that you're going to have to do. And it starts with significant investments into agricultural automation, right? So for onshoring, you would want to look at companies like Trimble or Lindsay or Rockwell Automation, because you're not going to have a dynamic where the American jobs that you create are the same jobs that are being taken right now by immigrants, whether legal or illegal, migrant laborers in California and agriculture. That's not something that is a solid plan. So the investment into agricultural automation is probably going to be significant if you want to effectively onshore in the US. And there are some other areas that you could look at on the long side that start to get a little bit complicated, like Deere or CNH Industrials, because the thing is, one of the tariffs that I do think will almost certainly happen is the steel tariff. So when you have companies where they have very significant input costs that are related to the price of steel, and if they're forced to buy domestically or pay a tariff, that could get a little tricky. So I think you could be concentrated on the long side with onshoring, and on the short side, focus on just Mexican equities broadly, because nearshoring has been a huge boon for their economy, and any shift away from it would probably be a net negative for them.
And James, what about energy? I remember, earlier in your Trump basket was some coal names, some oil names,
Mhm.
names that would benefit from a lot of activity. Um, do you think the price of oil will go down because Trump is so good for drilling? And also, if there's a ton of drilling and oil price goes down, it might not be good for ExxonMobil, but it might be good for the Schlumbergers and the Nobles, the offshore drillers, the oil services type companies, the Texas Pacific Land Trust, which make money when people drill. They're just basically a real estate that owns tons of land in Texas. Do you think that Trump is going to be successful in getting drilling to go even higher? I mean, the U.S. already produces so much oil.
Well, I think that this is one of those areas that you want to be more selective. I don't think that there's going to be this huge, it's a very complicated dynamic. And what I'm looking for is a first or second derivative play that benefits from the quote unquote drill baby drill and has a little bit less oil beta or could do well even if oil continues to go sideways, which I think is the motivation, at least for the Saudis. They do seem to be very comfortable with oil in this kind of 65 to $85 range. That seems like their sweet spots. It's interesting that you mentioned Texas Pacific Land because while they are a royalty company, like you described, the other segment of their business and the one that's growing the fastest is deals with produced water. And if I was speaking to Michael Spiker from HTM Energy, who does great research, and he was
Fantastic.
describing to me the dynamics of every barrel of oil that you pull out of the ground is going to create, anywhere from 3 to 12 barrels of water, and you cannot just stick it back into the ground. So that's becoming a problem, and it's a problem that is it's a bottleneck, right? And the best plays that probably anyone has had over the past, I don't know, year and a half, 2 years, have been buying the companies that are solving the bottlenecks, whether that's NVIDIA with GPUs or interconnects in AI, or some of the CDMOs for Lilly. I really like buying a bottleneck solver, and the Delaware Basin, for example, is basically overflowing with the water that's being produced. So the transportation movement of this water and then the treatment of it is very brackish water. You can use it again for fracking, or you can treat it and just get rid of all the kind of sediment and everything. So I'm looking at some of these produced water names because that seems like a pretty easy way to play at least the current dynamic, and then any added kind of drill baby drill is only upside for them. And I know you mentioned Schlumberger, and that could work, but I like this a little better because it seems like a more pure derivative where more drilling means more water, means more money for these guys. So TPL, Aris Water Solutions, ESOA, Kinetic, ARQ, these are all companies that deal with this problem, and that is going to create more money if we get that Trump kind of drill baby drill dynamic. And if we don't, if we continue doing what we're doing, the companies will probably do fine as well.
Yes. So TPL, they make money from royalties, land and easements. I think it's called SLEM, and then the water. But it's not like putting water into people's taps. It is all oil. It is all
Yes.
pretty much all from the oil company. It's a fascinating company. I believe it's the first company that Warren Buffett ever bought. Been around since the
Is it really?
1870s. Yes, and I think Jay Gould was involved in making it public or something. So the history
Oh,
of
that's
America
awesome.
is in that stock. One name that I do not own, and
It's also a C corporation. And most of these royalty companies are MLPs, which are, I don't know how people feel about K1s. I know there's divided opinion, but I don't like getting more paperwork. So I love the fact that it's a C corp.
I hate paperwork. They converted to a C corp. I know some TPL, long true fans were mad about that conversion, but I think that they've been doing it. I just will give a shout out to Murray Stahl of Horizon Kinetics, who's been a long time holder and bull of that stock. They also are getting into another company called Landbridge, which IPO'd
Yeah,
recently. You know about that?
yeah. We spoke about Landbridge when they IPO'd a little bit. It's very interesting company as well.
Yeah, and one of those companies, it IPO'd at probably 18, and then it went to 30, and I was, I saw Murray write about it. I said, oh, it's interesting. Then it went to 35. I said, oh, it's a great stock, but I missed it, and now it's at 60. So
Yeah,
classic.
that's kind of the way that there's this iconic moment where Ronald Reagan goes to the stock market and proclaims that let that bull loose. And I always wonder if I was investing then, if I would have uh, had kind of the clarity of thought and the simplicity of framework to just say, well, it's time to buy stocks. And
Yeah,
yeah, and there's I'm not saying that this is the same kind of thing, but I do think that Trump's cabinet will probably be over proportionally represented by Wall Street people. And this is kind of funny, but as far as Trump's concerned, the stock market is the Dow Jones, right?
mhm.
And we just added Nvidia to the Dow Jones, so maybe we get a little Trump put on the AI trade.
Trump put on the AI trade. Wow. So James, I was about to ask you, what do you think Trump's impact is going to be on the broad indices, S&P 500, the Dow Jones? It's great that you have these niche companies, you construct these little baskets, with your little chemistry set and your little Excel. But what's going to be in the impact on the S&P 500? You already answered it. You think Trump will let the bull loose and it will be a bull market. Citrini, S&P is so close to 6,000. I mean, it is hard to be super bullish on the stock market when the price to earnings ratio are, whatever, the 95th percentile expensive. It is a little challenging, right? Do you get a little concerned that it might be a little expensive and we need a healthy pullback, or the stock market needs to go down 10% and earnings go up 10% to, if the market's 20% overvalued, to return to fair value? Do you get a little concerned, or no, you're just let the bull loose, get me on the bull, I want to ride, give me my cowboy hat, I want to ride?
I mean, I am a strong believer in the fact that you don't do something until there's a reason to do it. And in terms of selling equities, I look at the kind of macro bear case, which I suppose the one thing that might give me a little bit of pause here is I think that the NFP print that we just had got a little overshadowed by all, the election and the FOMC, and that was a pretty bad print. And
Massively.
but also at the same time very noisy. There was a big input from the hurricane and the Boeing strikes, and so I guess if you're asking what would give me reason to be a little cautious, uh, the next NFP print I'll be paying very close attention to, as I think the market will. And if we start to get a trend where it looks like that print was not just noise, that might be a little bit concerning. Otherwise, like I said, I'm not. I've been long since in terms of comps, right? I look at the worries that were present a year and a half ago, or 2 years ago, and it's not worse now, right? And when the market tends to go up over time, and this spread sweep is likely very good for stocks, even in the macro bear case where the deficit implodes and we have 4 or 5% inflation, but nominal growth is 8 or 9%. The even in that case, it's great for stocks. So I think that there aren't a lot of reasons that I would have currently to start selling things. I do think that there will probably be some dynamics into the end of the year that will play out, but over the longer term, it does seem like we're setting up for uh, continued bull market. The only thing that is on top of mind in terms of reasons that I would sell is if the employment situation continues to deteriorate despite the Fed's easing of policy, that would be pretty concerning.
Yeah, I mean, the last non-farm payroll jobs, they added 12,000 jobs in October.
Yeah,
That's nothing. That's basically zero. And when it gets
and
to zero,
bonds sold off on it. So,
you're
that tells you
crazy.
something about whether the market thinks that's legit or not. But it is something where it would be pretty bad if we got a confirmation that the impact of kind of the noisier aspects of that print were not are continuing basically.
Yeah, I mean, if the labor market keeps on adding 12,000 jobs a month, that is basically recessionary. Yeah, I mean, it is recessionary, and I don't think that the economy and the stock market could handle that. So the jobs need to go back up. The unemployment rate needs to keep on going back down. The labor market is getting weak, and the softening of the labor market for a time was bullish because it was disinflationary. But if CPI if inflation is below 2% and the unemployment rate is skyrocketing, that's obviously an environment where stocks will not perform well and will drastically underperform bonds and cash.
Well, I noticed something about I think that Jerome Powell gave a pretty impressive performance at the FOMC where
I'm with you.
when he was asked would you leave if Trump asked you to leave, and his answer was just no. Very, very shut the effing door vibes with
Yep.
that one.
Which is the intro to my show, by the way.
Though, oh, is it really?
Yes, yeah.
Great pick. You should add the no.
I think they should. Max and I are in talks.
So I would say the fact that he spoke when he was answering questions, I think it was either twice or three times that he mentioned the attitude of investors when the 10-year yield was hitting 5%.
Almost exactly a year ago, yes.
Yeah. So, I mean, without outright saying it, he was basically saying that, in his opinion, bonds have bottomed. And I do think that when you start talking about the deficit and Treasury supply and all of that, I think that regardless of all of that, if we have a recession, people will buy bonds. So I think that when you have, when you have bonds and duration, it's a relatively simple thing to hedge against, at least in the short term, whether or not bonds have a higher kind of neutral rate because of I mean, unless you're really concerned about stagflation, which I'm not and have not been, you can easily hedge against kind of the weakening of the economy because rates are so high. And
Right.
you can make up for, everyone loves a positive expected value hedge. And I think if you look at buying 10s at 4.4%, well, it's easy to dry your tears about underperformance when you're getting paid carry.
And yeah, it's positive carry. You get to borrow money. Well, I guess at 4.6%, it's not positive carry yet. But
Well, I mean, yeah. I mean, yeah, but in terms of like just owning bonds in general, not borrowing, but that is positive carry.
on an unlevered basis, yes. James, you got two pieces out. They're very interesting. One is about the airlines. The other is about the payments industry. Talk to me about the airlines. I've skimmed over the airline industry. It's very, very tough business. In fact, you start your piece on the airlines with a quote. Basically, if there was a capitalist around when the Wright brothers discovered airlines, they would have done the airplane. They would have done well by getting rid of them, basically, because
Yeah.
airlines have just lost investors so much money, both mainly on the equity side, but also on the bond side. Actually, a book behind me by an airline specialist who I've interviewed about Delta Airlines. It's Delta Airlines, the only airline, I think, in American history at least, to never go bankrupt. So almost all airlines go bankrupt.
Yeah, I don't want to come on the show and say, I feel like a lot of people will perceive this as, okay, this guy called AI and GLP-1s, and now he thinks he can call airlines, so this is the end of that. And maybe that's the case, right? But just looking objectively, yes, airlines have tended to be a bad business, and that quote, that was Warren Buffett quote, by the way. If an investor was present at Kitty Hawk, he would have done his successors a huge favor by shooting Orville down, and that's been true. And every time that there seems to be a change to industry dynamics that is broadly positive for airlines, someone goes and screws it up. and more often than not, that someone is one of the airlines. It's kind of, and like we were just talking about drill baby drill. It's the same thing that happens in that industry where they can make more money, so they start really going for it, and then sooner than later, there's a kind of oversupply that kills everyone in the industry. So what I'm looking at though is a kind of comparison. If you look at the last time that airline returns were actually good, and there aren't that many periods that you can look at, but the last time was this end of 2012 to beginning of 2015, right? And during that time, you had Southwest that was basically leading the charge and returned, 310%. I think Delta was up a similar amount during that time. And basically, in 2012, Southwest had this strategic pivot to prioritize profitability over growth. And that was their kind of discipline resulted in capacity growth that was intentionally and artificially held below demand. And that enabled the first kind of sustained pricing power in the airlines industry history. Legacy carriers and regional players, they followed Southwest's kind of capacity discipline, and that led to historic operating margins and meaningful shareholder returns for the first time ever. Right? I think that was, if it wasn't the first time, it was the first time in a long time that ROIC exceeded cost of capital for the airlines broadly as an industry. So comparing that cycle to today, that was kind of a voluntary capital discipline where you had these kind of copycats that we're seeing how well Southwest was doing, and they said, well, we'll do the same thing in terms of keeping capacity low. Right now, as long as Airbus and Boeing don't get their shit together.
Yeah. You
Uh,
can say it.
as long as Airbus and Boeing keep this trend of the inability to produce more airplanes, that is a structural and exogenous capacity discipline where no single player can say, yeah, let's go, more planes. That's not a decision that they can make because it's not like they are making the decision in the first place for there to be capacity discipline. So the other kind of parallel to 2012 2014 cycle, the competition from the low cost carriers was really significant, right? And this new model of kind of JetBlue and Southwest and making your money on all the kind of extras, but with very low cost to the ticket. Now we're seeing a dynamic where the companies that can take advantage of first class, because there's been I mean, rich people in America are doing great, right? They are killing it. And it seems like they're only going to kill it more because Trump and a red sweep is on the margin a bit better, a lot better for wealthy people and for let's say the top 10% of earners than it is for the bottom 90%.
And they buy
And
business class, is what you're saying.
yeah, and
Remember when
so
people say no one would buy business class?
yeah.
It was true for a while.
Well, actually, it's right in, where it's right actually is the Midwest. Like like where like first class doesn't even really exist. These kind of like regional, uh, you know, um, I guess like a puddle jump route, when you're flying from like Minneapolis to like Des Moines. Yeah, so I think the way that I'm kind of playing this like it's a structural instead of a cyclical change. You have kind of converging labor costs. The way that I'm playing this kind of structural over cyclical change, to kind of capture the capacity discipline, less low cost competition, the undersupplied aircrafts, and also the kind of converging labor costs, right? There used to be a big differential between legacy and budget carriers. That's kind of because of wage inflation and because of unionization, that has kind of converged. So budget carriers being forced to slash capacity. So, some of them, like Spirit Airlines, facing like existential threats, probably be bankrupt before the end of the year. Although there might be some thing to be said about M&A there, if that environment gets a little better. And outsourced maintenance used to be this big key advantage, and now it costs multiples of in-house advantage. That's why, and the aftermarket aircraft industry has exploded. You look at like
AirCap.
FTAI, Heiko, TransDigm. So those companies have had massive gains, but there's this external rate limiter. So I think that the cost of those companies is limiting this capacity. So as long as those companies continue to do well, United especially, because they have this kind of embedded fleet optionality where the cheapest planes that United can buy are in its own fleet, and they've communicated that to the market, where that's why the buyback that they announced was such a significant part of their market cap. And with Delta, that they really have diversified revenue well and focused on well-positioned segments like premium revenue, and their tech ops are very good. Not to like throw AI into everything, but Delta's tech ops was responsible for a 75% year-over-year reduction in maintenance-related cancellations for the first 9 months of this year. And that's like predictive analytics and machine learning to basically make this fixed cost base increasingly efficient. So the way that I see it, the way that I'm playing it at least, is the main risk to this is uh, let's say aftermarket aircraft parts become really cheap, or Airbus and Boeing are able to produce more planes. But in the meantime, as long as that doesn't happen, I think that United and Delta, you can stay long there, and you can kind of hedge that a little bit by having limited risk, whether it's put options or smaller kind of short position with a call. You can have like negative delta on FTI and Heiko and TransDigm, and then a bit of positive delta on like Airbus and Boeing, and that
So
will
you're,
be
you're
your
short the
hedge.
companies that have super high margins, and you're long the companies that have super low margins.
When you say it like that, it sounds like a bad idea.
Yeah. Yeah, Jay. I mean, look, I've listened to a smart person make this case in 2019. Not as smart as you, but it hasn't worked out. Delta's probably flat, and a lot of them are down. So, I mean, if it
Honestly,
works, it'll be very
maybe
impressive.
he's
I mean,
smarter than
the
me.
companies are cheap. There's no doubt about that, James. Because we
Maybe
got
he's
limited time.
smarter than me, but it worked against him, because that's the thing is some, the smartest guy in the world probably saw AI coming in, I don't know, 2018, maybe earlier, and then bought Nvidia and had to sit through a 75% drawdown. And there's a difference between being smart and having the kind of, not a lot of people can sit through a 75% drawdown, right? That math is really not in your favor.
When I said
So
smart, I meant good. James, let's talk about AI. What's going on? Still long? Why?
Yeah, I mean, I think, the last time that I was on, we went pretty in depth about how I was thinking about it, and I don't think much has changed. I'm continually kind of narrowing down my exposure and trying to find the most asymmetric places to be. So the last time that I was on, we spoke about the decision to sell SMCI, which worked out well, and the decision to sell a couple other names and rotate into a more narrow implementation. And what I do think is that, um, a lot of discussion has been made about the next phase of AI and where the use cases and kind of the software angle and everything like that. Um, I think that the trade probably on the just like pure data center beneficiaries like Vertiv and Nvidia, and that is not over yet. I think that you probably have a little more to go on that. But it's becoming increasingly important to really be positioned in the places that are asymmetric. And the most recent kind of update that we did to this had to do with connectivity. And I think it was, I think we published in July or maybe the beginning of August, we published a primer on connectivity. And there were all these names that had some upside to data center, or definite upside to data center. But at the same time, they were kind of blown out because of this cyclical dynamic in telco. And that struck me as a way better place to be than all these names that had really very narrow margins of safety. So Lumentum, Sienna, Coherent, these were all companies that were trading, and then one that I traded like a moron, which was Marvell. I held on to it for probably 8 months as one of my bigger positions, and then I sold it at the exact lows. But other than that, the Coherent has done great, Sienna's done great, and it's really it's you don't want to overcomplicate it. They're coming out of this kind of cyclical depression, and things are getting incrementally better with their customers in telco. And at the same time, you get this massive embedded optionality on the AI data center, and especially what we have to, with all the data that's going to be produced, we have to connect you have nodes and spans, right? And the spans have to get better. We need to be able to communicate the data as quickly and effectively as possible. So yeah, I think connectivity has been a really solid place to do it. And I'm going to keep looking for areas where AI kind of opens the door and presents an asymmetric opportunity that has significant margin of safety, because I think there will be a few more.
What about this semiconductor industries? Obviously, semiconductors are only a fraction of your AI exposure, but you look at the big semiconductor names, and some people are saying it's getting a little overheated. Do you agree?
I mean, uh, again, it's like a dispersion thing. In some areas, yeah, and it's funny, right? Because this is the third or the fourth time we've done a podcast together, Jay.
Fourth.
Fourth, right? And I think that question has probably been asked on every single podcast, right?
Yeah.
So and my answer is kind of the same, where yeah, there are some areas that, and it's changed from probably the first time you asked that question. The answer was yeah, in these like really ridiculous companies that should not be up at all because they're going bankrupt or they're like materially harmed by AI. And now it's kind of, there are certainly some that are for sure uh way overheated and have to have some sort of mean reversion. But just the trend can continue as long as the data center build out does. And every single hyperscaler got on their earnings call and said, we're spending more in CapEx. And going back to what we said earlier about, there is, when you find something and it works really well, the best way to screw it up is to just constantly kind of tweak with it and change the framework in my mind, at least for AI, is make your money in the stuff that is obvious right now. Be relatively aggressive about taking profits, but only when to do so you have something else to put it into, right? To find. I mean, because as like we just spoke about with Delta, right? That's a very small part of the profit driver for Delta, but it's an example of predictive analytics and AI and machine learning really improving operational efficiency. And I think that before it's not going to be like it's not going to be a dynamic where you're really there, because of the fact that so few companies nowadays are IPOing early and are just opting to do these kind of venture capital raises.
You mean
It's,
IPOing late?
well, so many companies are IPOing when they're at like later stages of their business,
Yeah,
right?
yeah,
Like
yeah.
and just like the so and then some of the companies that do decide to IPO, especially in the AI space, are kind of, not great.
Yeah.
So I think that the way to play it going forward is basically going to be to find these kind of mature companies that really have added AI kicker that the market isn't pricing in. And some of them have gotten that priced in to some extent, but there will be more because this technology is here to stay. And every single day we will find new and unpredictable use cases for it, and that is what's going to color the investment landscape for a little while. I do think that, like I said last time, that increasingly it'll be less a function. I mean, when we were coming out of the bear market, it was Nvidia just driving the entire conversation, and as the bull market kind of took hold, you got more dispersion and people were comfortable enough to own something that wasn't Nvidia, and that will continue to occur. Although I do think that we do have a little bit longer on the data center stuff, but you have to be aggressive about being honest where you should take profits. Like the Supermicro stuff is a perfect example. When I bought it, it was super sketchy, but because it was super sketchy, it was trading at 2x earnings. And you don't get the opportunity to buy things at 2x next year's earnings unless there's something that the market is worried about. And so I think that the best returns that you're going to make going forward are going to be these kind of turnaround stories or companies that are in a cyclically depressed area that have a kicker from artificial intelligence.
Thanks so much for coming on. People can find you on Twitter at Citrini7. You're a great poster. People can find your research, Citrini Research. Tell people why did you start Citrini Research and what do you offer?
Yeah, so we started because actually the reason why the first thing I ever posted was in May of 2023 about AI, because I was looking for an AI basket and I found one from a bank that I'm not going to speak harshly of, but it was.
I got to cut something. A lot of banks, like 6 months after you put something out, or honestly 6 months after I interview you, so probably 9 months after you put it out, they do. So they're 9 months late behind you, and it's just so low quality, and it's just like, why read these banks?
Yeah, and it's colored.
I love some bank
but,
stuff, particularly their economic stuff, and their stuff on credit and bonds is really, really good. But
yeah.
I mean, some of their stuff in equities is just, come on.
Well, it's colored by the relationships that they have with the companies. But I looked for, and because I had the idea that I didn't want to just own 100% Nvidia, right? I wanted to because I recognized that the trend was here and the theme was strong, but that the technology would change so quickly that it would become unpredictable. And I didn't think highly enough of my own intelligence to think that I was going to predict every single turn that occurred there. So I wanted to be more diversified within the theme. And I couldn't find anything that met that kind of requirement. So I made it myself, and that was kind of the first thing that we ever published on AI. And now we've grown, and we take an approach that is top down and utilizes all the information that's available to us to cover these market themes as well as we possibly can, and the kind of the research that investors deserve, and research that you'll never read and get to the end and be like, okay, so what's the trade here, right? The primary focus of everything that we write is being actionable. We'll never write anything where you're left wondering if this is something that you should invest in or not.
I really love your work, and people should check it out. Thank you again,
Thanks,
James, and thank you everyone for watching. A reminder, people can find Monetary Matters not just on Apple Podcasts, Spotify, their favorite podcast apps, on YouTube, and check out my friend and business partners podcast, Other People's Money. Until next time.
Have a good one, Jack.
Thank you. Just close this door.